In a general sense, I think we've got two couple suggestions here, and I'm actually on schedule. Then I'll open it up to questions. First of all, I think going forward, that old KISS formula about keep it simple still applies. Embrace the major global trends that are likely to be in place for the next 5 to 10 years. For us, that is, many of the emerging markets have younger demographics. They have very little debt. They are hungry people. They're enthusiastic. I can remember an annual report from a Vietnamese company that made just basic electric transmission equipment, switches and resistors and stuff like that. It was given to me a couple of years ago when somebody was trying to get us to invest in Vietnam, which would have been a good idea, but it's outside our area of expertise. There must have been 75 people standing on the front steps of this company. Every one of them had either a black slacks or black skirt and a white shirt. And except for the fact they were all Oriental, it looked exactly like a picture in the 50s for some company photograph. They're serious about wanting to move forward. The internet, the transferability of technology today has made it possible for them to be able to access knowledge much faster. The competitive advantage of having technology isn't as lasting as it used to be. These people are going to work very hard to advance their cause. They're going to be very serious competitors, and they're going to continue to gain market share in global GDP. And then I think finally, we would argue that you have to embrace the reality that the dollar is in secular decline. It is overowned by virtually everybody in the world. One of the ironies is the Chinese, for all the whining about not liking the dollar as a reserve currency, actually increased their total portion of global reserves from 64, I think, to 67% in the last 3 months. So for all the whining, there's no place else to go, which is why we really don't think you'll see a phenomenally sharp decline in the dollar. It's incredibly negative for the Europeans and the Japanese to see the dollar go down very fast. They will do what they can to resist their currencies going up against it. But in the long run, there are simply too many dollars out there. There are too many reasons why emerging markets don't want to have to be dependent on it. For the moment, the Chinese are stuck because there's no place else to go, and it's not easy to scoot over towards the door in the auditorium when you think you smell smoke, because these days everything is so measured. We know how many treasuries the Chinese own on an every 90-day basis, in some ways every 30-day basis. They would like to get out of that auditorium without causing a panic, because if they do, the dollar would go down too fast and they lose a tremendous amount on their $2 trillion worth of foreign reserves. But on the other hand, there's no easy way to get to the door without people measuring. So I'm not sure how this plays out, but we don't think you'll see a major sharp decline in the dollar. The move in gold in the last few days would argue that maybe that's still a possibility. I think too much of the world suffers if the dollar goes down very fast. So we would nonetheless think that you plan for an erosion, you just don't try to bet on an abrupt decline. And then within the global trends, play the inside trends. Global technology will continue to advance. One of the nice things that the U.S. still has going for it is the major breeding ground for new technology. China will continue to try to gain share. A company like Huawei, which is, for those of you not familiar with it, a small Cisco, not as technologically competent at this point, prone to copying IP without paying for it and things like that, is nonetheless coming up the curve very fast, because they can pretty much guarantee that a lot of the Chinese demand will go to them in a self-interested kind of fashion. But in spite of that kind of issue, by and large, the U.S. continues to be an excellent source for emerging and continuously evolving technologies. We think you can play global technology and the demand for those products worldwide, because even in a slow-growing Europe or a slow-growing Japan, they will continue to move up through wireless to next-generation systems. That kind of transition to the things that support iPhones and the like will be essential. Capitalize on it. Capitalize on global consumer goods. A lot of people don't realize that the Procter & Gamble's and the McDonald's of the world have more business outside the United States than they do in the U.S. The global consumer will buy a lot of American-created and American-sold products. we advocate logical resource plays because we think on balance, demand over time will exceed the readily available expansion capacity in some resources, but we're not one that's an advocate of outright commodity plays right now with copper spiking and some of these others, all predicated on China's recovery. We'd be careful about that, look for the longer term ways to play through the Alcoas and the like, where more aluminum capacity probably doesn't come on stream until you get adequate returns on the existing plant and equipment that's out there for them and their competitors as well. And somehow you have to get into the emerging markets. I have no suggestions how to do that with it up as much as it is. It's great if you put money into it towards the end of last year or the early part of this year, but those are very, very thin markets. They adjust very fast. China's market was down 20% in the month of August. That officially mandates a new bear market. I could take that with a grain of salt. These things are so illiquid, I'd look for some kind of break and a little less enthusiasm for them to make a point of entry. Finally, plant and harvest. Again, I actually was born in Detroit. Ended up moving out west for probably a lot of reasons if you spend any time in Detroit. But I think with the volatility that's here today, you harvest your returns when you can get them. I wouldn't go quite so far as say put it in a tin can in the backyard after you harvest, but the truth is with 2 or 3 or 4/10% money market kinds of rates, you're basically putting it in a can every time you take it out of the investments. I think you nonetheless have to be prepared to harvest when something's run far enough that it makes sense to take it off the table. My point to the high-yield bonds is a good example. Keep in mind also that it's a little bit of a delusion when you invest around the world thinking you're diversifying. The correlation between market behavior, between commodities, emerging markets, U.S. and other developed markets is higher today than it's been at any time since they started measuring this. So they all tend to go up together and down together, partly driven by the leverage that pushes these processes. You want to be diversified globally, but don't be complacent about it. They will all tend to go down together too when they find a reason. We're more inclined to harvest than plant right now. We've been taking more off the table on a gradual basis. I'm amazed that this rally's gone as far as it has. We still find a lot of things we like in the small end. The global companies grow by virtue of reinvesting their retained earnings in future growth, and they go to the parts of the world that give them the most growth or the prospect of the most growth going forward. It's more of a buy and hold strategy. But I would be cautious right now, and I certainly wouldn't be chasing my way in if I missed the opportunities prior to the rally in the last 6 months. That's really it. Any comments that I might have about the market probably bear on what I've already said. This rally has been remarkable. It's been rather thin at times. The end result is there's too much expectation built around a recovery that's likely to be not as strong as people want. And with that, I'll open it to questions.